The income ETF space has exploded. There are now more than 80 covered call ETFs listed in the United States alone, managing hundreds of billions of dollars, and the criticism that follows them is equally loud. Fees are too high, NAV erodes, you are just getting your own money back, as a distribution, and you would have been better off in a simple index fund. Some of that criticism is completely fair, some of it completely misses the point of what these products are actually built for. Today I have a guest who has spent a career at the institutional level building and managing the exact kinds of strategies that retail income ETFs are now making available to everyday investors. We are going to go through everything. Who income ETFs are actually appropriate for, why the expense ratio argument is more nuanced than it sounds, what NAV erosion really means and how to tell the difference between erosion and genuine income generation, how option-based strategies can actually be more tax efficient than a traditional dividend fund, and how to use leverage responsibly in this space without playing with fire. This is the educational conversation that should happen before anyone buys a high-yield income ETF. Welcome to the channel. Before we get into the deep end, I want to start with the foundational question because I think it is genuinely underappreciated. When someone says they are building a portfolio, there has always been this tension between growth and income. The traditional advice is, when you are young, focus on growth. As you approach retirement, shift toward income and bonds. But the income ETF space is now offering something different, products that attempt to generate income on assets that do not traditionally pay income at all. Walk me through the problem that this actually solves for a real investor.
The traditional growth versus income trade-off has always been the central challenge in portfolio construction. Institutional investors have a playbook for this. They call it a life path or glide path strategy. When you are young, you own equities because you want price appreciation and you do not need current income. As you approach retirement, you rotate into bonds to generate steady cash flow and reduce portfolio volatility. The problem is that this model assumes a few things that are becoming less and less true for a growing segment of investors. It assumes you have a salary that covers your living expenses, so your portfolio can compound untouched for decades. It assumes you will eventually reach a large enough nest egg that the interest and dividends from a conservative portfolio will cover your needs. And it assumes a low-rate environment in which the bond portion of your portfolio does not significantly drag on your returns. None of those assumptions hold consistently anymore. So what we were asking was, can we generate income on assets that do not naturally produce income? Can we put a consistent cash flow on a growth stock, a commodity, a technology basket, something that has historically only appreciated in price without distributing anything? That is the problem option-based income strategies actually solve.
Some investors hear the phrase option-based income and they immediately think about the expense ratio. The argument is that you are paying a manager significantly more than you would for a plain index fund, and that fee drag compounds against you over decades. How do you think about that criticism?
I think the fee conversation has to start from the right premise, which is after-fee total return. That is the only number that matters. If I charge you a higher fee, but I deliver you a higher after-fee total return than the cheaper alternative, then I have justified the fee. If I charge you a higher fee and deliver lower after-fee returns, then I have not. It is very binary in the investment business in a way that is actually clarifying. The question is not whether the fee is low or high in isolation. It is whether the strategy delivers enough value net of that fee to justify it. Now, for a long time in a zero-rate environment, the argument for low-cost passive investing was very strong. When all risk assets are rising together and the market is efficient, buying the broad market at the lowest possible cost is a hard approach to beat. But we are in a different environment now. Idiosyncratic risks matter more. Policy changes can move markets overnight. Active management has more genuine opportunities to generate excess return in that kind of environment than it did in a decade of low-rate, everything-rising conditions. The answer to the expense ratio question is, do not ask whether the fee is high. Ask whether the after-fee, after-tax return has justified it. If it has, stop complaining about the fee.
Host, let me bring up the question that probably gets income ETF investors the most anxious, which is NAV erosion. There is a widely circulated criticism that high-yield income ETFs are essentially returning your own capital back to you as a distribution. that the yield is not income, it is just your money coming back in smaller installments while the fund slowly deflates. How do you separate a genuine income-generating strategy from one that is just eating itself?
Guessed. The analogy I use is a landlord. You own a rental property and it generates $2,000 a month. 1 month a tenant pays late, and you only collect $1,000. Do you start selling pieces of your kitchen to make up the difference and mail your tenant their $2,000 anyway? Of course not. Because you would be returning your own property to cover a shortfall that is not real income. And yet that is exactly what some high-yield funds are doing. They set a target distribution rate, say 50 or 60 or 70% annually, and then they pay it regardless of whether they actually earned it that month. When they have not earned enough, the gap comes out of NAV. Your principal is shrinking. And the really painful part is that this creates a tax problem on top of the capital destruction. You receive what is classified as a return of capital distribution, and you owe taxes on it even though the fund just handed you back a portion of what you originally invested. If I give you $100 and then give you back $90, you did not make $90. And in fact, you are poor because you paid taxes on the $90 they returned to you. That is not income. That is a slow liquidation of your position dressed up with a yield number. The way to identify a fund that is genuinely earning its income versus one that is giving itself away is straightforward. Look at the NAV trend relative to the underlying asset. If the fund owns Google and generates income on Google, and Google rises 10% over the year, you should expect the fund to have also risen. Maybe not the full 10%, but somewhere in that direction. If Google is up 10 and your fund's NAV is down 5%, something is wrong. The fund is over-distributing relative to what it earned. That gut check, does my fund roughly track the direction of the underlying asset, just with a distribution on top, is the single most useful filter for identifying NAV erosion.
That raises the natural follow-on question. Most standard covered call ETFs do explicitly cap their upside. That is the mechanism by which they generate the premium. So how does a fund that uses option strategies manage to keep pace with the underlying instead of consistently lagging it?
The key insight is that there is a significant difference between a covered call ETF and an option income strategy. A pure covered call ETF writes a covered call on the underlying, you own the stock, and sells someone the right to buy it from you above a certain price. That single trade gives you upside to the strike price and premium income, but nothing above the strike. In a sideways market, that works well. In a sharply rising market, you get capped out and you underperform. An option income strategy does something more sophisticated. Yes, you write a call slightly out of the money to generate premium, but you simultaneously buy a further out-of-the-money call on the same underlying. This is called a call spread. The long call you purchase is cheaper because it is further from current prices, but it activates if the market surges past your short strike. So in a sudden price move upward, that long call captures the move above your written strike. You have not fully capped your upside. You have capped your cost of upside participation. You can also add protective structures on the downside, buying a put funded by writing a further out-of-the-money call, creating a net neutral cost structure that provides protection while maintaining income generation. These combinations allow the strategy to behave much more like the underlying asset, participating in price appreciation while still distributing premium income, rather than a pure covered call that trades all upside for income.
I want to spend some time on tax efficiency because tax season has created a lot of confusion in this space. Some investors received distributions classified almost entirely as return of capital. Others got hit with significant ordinary income. How should an income investor think about the tax profile of a high-yield ETF? And what makes some of these strategies genuinely more tax efficient than others?
Tax is integral to the investment thesis, not an afterthought. When we first adapted institutional option strategies into ETF form, one of the biggest surprises was discovering how tax inefficient those strategies were in their original design. Institutional investors like endowments and pension funds do not pay taxes, so those strategies were never built with tax efficiency in mind. And when you wrap them in an ETF and sell them to taxable retail investors, you create a serious problem. The starting point for understanding tax efficiency in income ETFs is this. Traditional income, interest from bonds, dividends from stocks, is taxed at ordinary income rates. Whatever marginal tax bracket you are in, that is the rate you pay. But once you move into options-generated income, you enter the capital gains regime. And in the capital gains regime, you have the potential to access the lower long-term capital gains rate, 15 to 20% for most investors versus 22 to 37% for ordinary income. That alone can be a 17 percentage point difference in the tax rate on your income, which is enormous. Now, not all option income automatically qualifies for long-term treatment. Positions held for less than a year are short-term gains and taxed at ordinary rates. So structure matters. There are specific categories of instruments, notably index options, commodity options, and gold futures options, that receive what is called Section 1256 contract treatment. Under Section 1256, gains are automatically split 60% long-term and 40% short-term, regardless of how long you held the position. For an investor in a high bracket, that is a meaningful structural advantage. Additionally, active management within the fund can generate return of capital distributions through loss harvesting, timing the recognition of losses against gains within the portfolio to classify some of your distribution as return of capital. Return of capital is not taxed in the year you receive it. It reduces your cost basis, and when you eventually sell, you pay the tax at long-term rates. That deferral plus the lower rate is a compounding advantage over time. The key insight is that the tax classification of income distributions is not accidental. It is a function of what instruments the fund uses and how actively the manager harvests losses. Reading the prospectus to understand those mechanics before you invest in a high-yield fund is not optional. It is essential.
Let me ask you the question I think a lot of newer income investors are wrestling with right now. The argument for income ETFs seems compelling on multiple levels: the dollar cost averaging mechanism, the cash flow flexibility, the ability to generate income on assets that do not naturally pay dividends. But who are these products actually for? You have mentioned that institutional investors view all return as equivalent regardless of whether it comes as income or price appreciation. Is there a legitimate argument that retail investors should think about it differently?
Yes, and it is actually one of the things I had to unlearn coming from the institutional side. The institutional view is theoretically correct. A dollar of price appreciation is economically equivalent to a dollar of income. Total return is total return. The institutional investor does not care where the return comes from. They have dedicated teams to convert whatever form the return takes into cash flow as needed. But most individual investors are not running a dedicated cash management team. They are making these decisions themselves, and the practical reality is that income inequality has worsened to the point where a significant portion of investors do not have enough salary-based income to consistently fund contributions to their portfolio. The traditional model, put 10% of your paycheck in your 401k every month and let it compound, only works if your paycheck covers your lifestyle, plus that 10% with room to spare. For many people, it does not. So the income distribution from an income ETF serves a specific mechanical function. It creates automatic cash flow from the portfolio itself that can be reinvested, redirected to other asset classes, or used to fund expenses. That cash flow management function, the ability to systematically dollar cost average into your own portfolio through reinvestment, or to rebalance between strategies using the income stream rather than adding new capital, is genuinely underappreciated by institutional investors because they have teams that handle it. For a self-directed investor, that mechanism is real and valuable. For retirees specifically, the function is more obvious. Your salary is gone, your living expenses have not stopped, and an income stream from a diversified set of option-based strategies, many of which are more tax-efficient than bond income, can serve as a salary replacement. That is a legitimate use case. The honest answer is that income ETFs are most valuable for retirees and near retirees who need current cash flow with lower tax liability than bond income would generate. Younger investors who want a systematic reinvestment mechanism, but whose salary is not generating enough surplus to contribute conventionally, and investors who want to actively manage their portfolio allocation by redirecting income into undervalued segments rather than being purely passive. They are not optimal for institutional investors or for high-income earners in growth mode who do not need the cash flow and are maximizing tax-advantage accumulation. Matching the tool to the actual use case is everything.
One more topic I want to cover because it is showing up more and more in this space. Leverage. Some ETF issuers are deploying 1.2x, 1.5x leverage on their income strategies to boost the headline distribution. Some investors are using margin at the account level on top of these products. What is the appropriate framework for thinking about leverage in the context of income investing?
I started my career in the Great Financial Crisis. So my starting point for any leverage discussion is always, how bad can it get? Because the decade or so after the crisis has been an almost unbroken bull market. Most investors who are active in the market today have not experienced a prolonged, severe drawdown. They experienced the COVID crash, which was violent but recovered within weeks. They experienced Liberation Day in early 2025, which was sharp, but likewise recovered quickly. But a sustained year-long or multi-year decline of the kind that happened between 2000 and 2002 or during 2008 and 2009, that is a different category of experience entirely. And leverage dramatically amplifies that experience. For a leveraged ETF, the question is never whether it is returning 1.5x the underlying in good times. It almost certainly is not, because daily rebalancing creates compounding friction that works against you in volatile environments. The question is whether it will lose 1.5 times the underlying in a severe drawdown. And the answer to that is closer to yes. Leverage is a weapon of mass destruction used irresponsibly. There is a narrow, legitimate use case. If you have very high conviction in a specific position and you understand exactly how much capital you stand to lose on the downside, and that loss would not impair your ability to stay in the trade, then a measured amount of leverage on a specific thesis can make sense. But using leverage because the market has been going up, or because you want a higher distribution number, or because the cost of margin seems manageable right now, those are reasons that have ended investment careers. The analogy I come back to is card counting. People who lose badly at cards generally do not lose because they consistently get poor hands. They lose because when they get a decent hand, they bet too large. Their liquidity problem becomes a solvency problem. The same dynamic plays out in leveraged investing. Keep position sizes that allow you to survive being wrong. If you cannot answer clearly how much you would lose in a 40 or 50% drawdown of the underlying and confirm you can absorb that, you should not be using leverage in that position.
Last question. If you had one piece of advice, not about any specific fund or strategy, just about the mindset an income investor needs to succeed over the long run, what would it be?
Be curious. And I mean genuinely, relentlessly curious. Not just about the products you already own or the ones being marketed to you, but about the underlying assets those products are built on, the option mechanics they use, the tax structures that determine what you actually keep, and the macro environment that determines when those structures perform well and when they do not. We are in a genuinely interesting and genuinely challenging market environment. Correlations between assets are shifting. Policy changes move markets in hours. The Mag 7 dominance of the last decade is showing structural signs of moderating. Memory semiconductors, AI infrastructure, European fiscal policy, commodity cycles. There are new themes and new opportunities appearing that experienced investors with rigid frameworks are missing precisely because those frameworks were built on the conditions of the last 15 years. The investor who approaches this environment with curiosity, who asks why a strategy works before assuming it will continue to, who reads the prospectus, not just the marketing, who understands the tax treatment before they buy, that investor has more edge right now, not less, because so many of the old assumptions no longer apply. Be curious. It is the most durable advantage available in this market.
Genuinely one of the most substantive income investing conversations I have had on this channel. The frameworks you laid out today, how to identify real income versus return of capital, how to evaluate leverage risk, how to think about tax efficiency across different option structures, and who income ETFs are actually built for, are exactly the kind of analytical foundations that most content in this space skips over. If you found this useful, hit the like button and subscribe. Drop a comment below with the income ETF question you would most like me to cover in depth next week. I read every single one. I will see you in the next one.